Hello and welcome to the Centuria Government Income Property Fund webinar. My name's Stuart Wilton and I'm the fund manager of the fund. And I'm just going to provide a bit of an overview to the transaction, the investment in the fund, by taking you through a presentation that we've put together that summarises the deal. Okay, so firstly, I might just start with providing a little bit of an overview of how the transaction came about. So the property which the fund's acquiring is at 1 McNab Avenue in Footscray. It was actually brought to us off market via an agent down in Melbourne from Knight Frank. They went to 3 parties because the asset's being sold by the Grollo family and it was originally developed by Grocon. So as you can appreciate, there's a reasonable amount of confidentiality that they were seeking due to the publicity around the group and the family as a result of recent events. So from that point of view, we do see that you could potentially see that this may have been a slightly motivated sale as a result of those events as well. So the groups that were included within the process were Centuria, Investor, and Charter Hall, and ultimately we were selected as the preferred buyer, obviously not only on price but also the fact that we've got a strong track record in non-CBD and metropolitan assets, and we've also had a good reputation for being good to deal with, but also transacting and having conviction in the deals that we've completed in the recent past. So that's just to give you a bit of an idea of how it came about. But clearly, again, the off-market nature of this deal is a positive in our view. So just as an overview, the fund that we're launching or have launched is a single asset, unlisted, closed-ended property fund. And as I mentioned earlier, we're acquiring a property at 1 McNab Avenue in Footscray for $223.7 million, which equates to an equivalent yield of just under 4.7%. So the asset's fully leased with 91% of the income, which is underpinned by Victorian government and state-owned entities, and it has an 11.8-year WALE, which we see as a huge attribute to this particular property. The starting distribution in FY22 is 5.25% annualized and moving up to 5.35% per annum, and over the 5-year period we see an average of around 5.36 over the initial fund term of 5 years. Based on an initial gearing of 49%, we're forecasting a terminal NTA of $1.09 and a LVR of 7.11%, which is post fees and pre-tax. It is important to note, though, that with that 49% gearing, even though it's slightly higher than our previous funds that we've launched, given the nature of this asset, the tenant covenants as well as long-term leases, we thought it was a reasonable gearing to be able to go up to, particularly given we've got a 60% LVR covenant under the 5-year debt facility that we've secured. So the headroom is fairly similar to some of the funds that we've launched in the past, and essentially you'd have to the value of the property would have to reduce by close to 19% in order for us to get to that 60% LVR covenant. Another attribute of this particular asset that we see as very attractive is the sustainability credentials that it has, and also the ESG ratings that have been achieved. So the property has a 5.5-star NABERS and energy rating, as well as a 5-star Green Star rating. So it's been built to an extremely high standard, both from a construction point of view, but also a sustainability point of view. On to some more fund highlights. So the top 4 we have covered, but the other thing that we really like about this particular deal is the fact that it's located within Footscray, which is currently undergoing some significant gentrification and development. And as a result, over the next 5 to 10 years, we do see a material locational uplift. And this is as a result of that development I just mentioned, but also some significant forecast population growth particularly within the next 10 to 20 years. And it's estimated that the population will double over that period. Furthermore, the property has also been identified as a suburban government hub. So the Victorian government has identified 5 areas within Victoria as suburban government hubs, which is an initiative to allow Victorian public servants to work closer to home, but also encourage people to return to the office in order to generate or stimulate those economies within the commercial precincts in and around Melbourne. So again, this just underpins the government's commitment to this area and the fact that they are likely to be there long term. Otherwise, they wouldn't have nominated this particular property at 1 McNab Avenue as one of the 5 government hubs. So it just reinforces the location as a long-term government precinct. All the leases within the asset, there are 6, are on a net basis, so all outgoings are fully recoverable, and they have some healthy fixed annual rent reviews of between 3.5% and 4%, which provides some pretty healthy built-in rental growth, particularly when the 3 main leases have got close to 13 years remaining. So from a timing point of view, we are seeking to raise around 133 million. Applications at this stage, we're seeking to be delivered on the 28th of July, and along with that, the funds to be provided on that date as well. So we're about a week into it at the moment, and all things are going really well, and the offering has been received very well within the marketplace as well, so which is encouraging. So onto the investment rationale. We have touched on a number of these items within this slide, but down on the bottom left hand corner, I would like to point out that these are first term government tenants, and the asset was actually built in partnership with the Victorian government and Grocon. So the combination of those 2 elements and the fact that it has been identified as a suburban government hub, as well as a priority precinct, which I'll touch on later, we do see there being a strong probability of the main tenants within the building renewing as a result of that. So that's obviously encouraging, the fact that it was constructed to the specifications and pre-committed to by the government back in 2014 when it was built, and it's also an area that they have invested heavily in and are forecast to also create a number of other projects in and around Footscray, particularly from a transport infrastructure point of view. So again, it's a location that we do see as an important one for the Victorian government. There's just some photos of the asset itself. As you can see, that the building has been built to an extremely high specification, and the quality of the accommodation is extremely high. Excuse me. And we do see it as some of the best accommodation within the Melbourne fringe markets across Victoria, that's for sure. So it is an extremely well built and well presented asset. From a tenancy point of view, as we mentioned earlier, it is 100% leased, with 91% of the gross income underpinned by the Victorian government as well as state-owned entities, which are City West Water, the Department of Treasury and Finance, and also the State Trustees Limited. So they combine for that 91%, those 3 tenants. And then there's 2 other tenants on level 5, Carina Ford Lawyers and McConnell Dow Constructions, who are also within the asset, and they come up within the 2022 calendar year. And we've had discussions with those tenants, and we're confident that there's a high probability of them renewing when their lease terms come up early next year, early to mid next year, I should say. So from an asset point of view, the one thing that we do like about this property is that there are actually 3 separate leases over the building. So the 3 government and state-owned entities, City West Water, State Trustees and the Department of Treasury and Finance, are all on separate leases. So what in effect you're getting is a multi-tenanted government-backed asset with an 11.8 year WALE and close to 13 years remaining on the main 3 leases, which we think is extremely rare and haven't come across in our time, because normally What happens with government leased assets is there's a single lease, single long-term lease over the property, whereas in this instance, you've got 3 separate leases. So you do have a diversification of income, as well as a multi-tenanted asset that can help you potentially stagger the lease expiries when they come up. But it also, as I said, gives you some diversification of income, and it's not just tied to one lease. The 3 leases also have 2 5-year options, and interestingly, there is an open face market review, which essentially means that incentives are not to be taken into consideration when reviewing the rent to market at exercise of option, if the tenant does exercise their options, which again is extremely rare and unusual. So what that does is it provides some leverage for us as the landlord to potentially renew these leases early by going to each of those occupants and potentially providing them a market incentive in order to extend those leases, which they normally wouldn't have under their option exercise structure. So the combination of those elements that I've just covered, again, just really makes this a unique, rare and fantastic opportunity particularly from a tenant covenant and lease structure point of view. So there's the 3 tenants, the 3 main tenants, for a bit of information on who they are, but it's fairly self-explanatory, so I'll keep moving. So onto the location. As I said earlier, this is one of the things that we do really like about this transaction. Aside from the fact you're acquiring an extremely high quality asset built in 2014 with long-term leases to effectively the state government for another close to 13 years, which results in an 11.8-year WALE, you are buying it within an area that is definitely emerging and undergoing some significant change as we speak. So Footscray has actually been identified as one of 6 Melbourne priority precincts. And basically what that means is the inclusion of that signifies a commitment from the Victorian government to deliver a growth strategy that will deliver significant returns for the community in terms of employment growth, sustainable development and enhanced livability. So what they've done is identified Footscray as an area where they're looking to invest in heavily and have a strong focus on to grow the area and improve the amenity, transport, connectivity, and essentially change it to become more like a CBD-like environment. So clearly there's a big focus from the government on investing in this area. So over the initial fund term and even beyond, you're going to see a dramatically different location and enhanced area from what it is today. But having said that, there still is quite a bit of development that's currently underway, particularly from a residential development point of view. And that's largely because, as you'll see there, the population is estimated to double in the next 20 years. So there is quite a bit of apartments being built, and there's in fact over 5,000 apartments that are currently under construction or in the pipeline or being actively marketed, as you can see on that slide there. And also I'd like to point out that immediately adjoining 1 McNab Avenue is an Oxford and Investor build to rent site. It's a significant development that's they're looking to include 700 units across 3 towers to be delivered in March 2024. And this is it is earmarked to be a landmark development, but also something that's going to be of premium quality and include a significant amount of amenity, which would also potentially benefit the employees and occupants of 1 McNab Avenue as well. So it also just underpins the confidence in the location, because groups like Investor and Oxford, who are seeking to build a $450 million development, clearly got some confidence in the location as well, and the potential for it to expand and grow over the next 5 to 10 years, if not more. So onto the infrastructure side of things. So There are a number of projects that are likely to directly benefit Footscray, or they will actually significantly benefit Footscray. The two in particular are the Melbourne Metro Tunnel. So this is a new train line that's being built and hopefully delivered in 25 to 26, around that time frame. So in the next sort of 4 to 5 years. And what this line will do is connect with the Sunbury line and come through Footscray, and then also go through 5 new stations within the CBD, which are currently being constructed. And of course through the Flinders Street station and Southern Cross stations as well. So it's designed to reduce congestion on the line as well as increase capacity, but it's also going to provide access particularly to the western suburbs, to areas of the CBD and metropolitan Melbourne, which they previously wouldn't have had. So once this line in particular is completed, many people see Footscray as being a gateway to the west and the CBD, because it will have some of the best connectivity out of any Melbourne suburb across the metropolitan area. So that again will enhance it as a commercial precinct and allow people to move in there from a residential point of view, but also as a commercial office destination too. The Melbourne Airport Rail you see down there on the bottom left, so that's a $10 million project, which again will go through the Footscray train station, which is being upgraded as well. And trains will come through Footscray every 10 minutes and get you to the airport within 18 minutes and go through the CBD on its way too. So this is something that people within Footscray and the western suburbs haven't been able to do previously. And as we know, getting out to Melbourne Airport and Tullamarine is not the easiest of tasks. So this rail will be a game changer from that point of view. So the Footscray Hospital is also undergoing a significant $1.5 billion redevelopment. This is actually Victoria's largest ever healthcare infrastructure project, and will include 500 beds, an additional, I think it's 18 or 15,000 patients to come through that hospital each year. So it's a massive increase and a huge project. So that again will also draw people to the area. So the combination of the hospital, the improved transport connectivity, also its proximity to Victoria University, is just going to bring a significant amount of people within the area and completely change Footscray as a location. And with that population will also come some enhanced amenity as well. So touching on the Footscray suburban hub, so the government's spending around $25 million to create 5 of these hubs. The first one is Footscray in 1 McNabb Avenue, so it's level 9 as part of the Department of Treasury and Finance floor. And the other 2 locations that we're aware of is in Williams Landing and also Mulgrave, but the other 2 are yet to be determined. So as you can see, the rollout's expected to accommodate as many as 2,380 office-based public servants to complete 90,000 shifts. And at 1 McNabb Avenue, since opening on the 1st of February, and this data is probably a little bit old, but it's on their website, more than 384 expressions of interest have been received. So clearly there's quite a big uptake and an initiative that the Victorian public servants are embracing. So again, it's a great a great support for the property and location that it's been identified as one of the 5 that the Victorian government's nominated as these suburban hubs. Excuse me. So this slide just touches on the confidence within the commercial office sector, particularly from offshore purchases. As you'll see, in 2020, for any transactions in the office space that occurred over 50 million, 64% of them were completed by offshore purchases, which just demonstrates the attractiveness of Australia, as an investment destination, but also in the commercial office sector as well. So we are seeing that for assets, particularly like 1 McNabb Avenue, that yields are at least at pre-pandemic levels, if not sharper, especially for long WALE, secure covenant, strong cash flow properties like One McNab Avenue. And as we mentioned with the off-market process, our view internally is you could potentially have seen a 25 to 50 basis point sharpening in the cap rate if this property was taken to market in a competitive process. So again, we see it as a pretty reasonable buy given the circumstances. So this slide just gives you a bit of an insight as to our experience within managing assets like this that feature predominantly government tenants. So we have a substantial portfolio, as most of you would know, but our largest tenant across the commercial office assets by far and away is the state and federal government. So we have a huge amount of experience in dealing with these types of tenants and properties that they occupy, and also have been extremely successful in securing a number of leasing transactions, particularly in the past 3 years. As you'll see there's been 80,000 square meters that have been leased since 2018. I suggest that's increased as a result of that data going back to the December half year. So we do see ourselves as quite an experienced manager with looking after properties such as this one. From a financial point of view, you can see there that we've outlaid the sources and uses just to see how we get to the debt to asset ratio, but also the starting NTA of 87 cents, which is predominantly made up of, I believe, 9.3 cents of that is stamp duty. As a lot of you would know, that's the largest cost. But we also see, well, the units will actually be offered at a $1 per unit as the issue price, but your starting NTA will be that 87 cents. But to get to that dollar unit price, we're amortizing the acquisition costs over the 5 years, as we've done with our previous funds, given the closed-ended nature of it. So fund structure is typical of a previous fund that Centuria has offered. So the initial term will be 5 years. At year 5, we'll have a unit holder vote to see whether investors would like to extend the fund for 2 years or sell the asset. We will put a recommendation to the unit holders at that time to identify which strategy we believe to be in the best interest of unit holders, and then it'll be an ordinary resolution on that vote to see whether the recommendation is passed or not. In the past, we have sold properties prior to the expiry of the initial 5-year term, so we'll continually monitor the performance of the asset and the fund, as well as market conditions, to determine whether we think it's appropriate to sell earlier or obviously extend the fund beyond that 5-year term. So they're the fees which are included within the PDS, so I won't spend too much time on that. And finally, just from a comparable sale point of view, we've included this because it does show that there have been some sales on market and off market where the cap rates have been sharper and the prices have been more expensive than what we're acquiring One McNab Avenue at, and arguably for inferior assets in inferior locations with covenants that are not as strong as the government. So again, this just reinforces the fact that we believe that it's been a quite a good buy, particularly during the off-market, particularly as a result of the off-market process. So a number of those cap rates you'll see sort of range between 4% and then up to 5%, but the majority of them are in that 4 to 4.5 range. So, and we're at around about 4.7%. So there's it does compare quite well to some other recent deals that have occurred in the marketplace. And just finally, I'd also like to finish on the fact that the rents within this building too are on average $460 per square metre net, and in other fringe markets in Melbourne, this is quite a big discount compared to those. So the average across the remaining fringe markets is around about $538 a square metre, which is roughly a 17% discount to that rate. So this combined with the fact that there's, for the past 3 years, there's been less than 0.5% vacancy within Footscray, and also there's forecast to be a limited supply, and we're not aware of any projects that are planned for Footscray at the moment, but clearly that'll change once the area evolves. So the combination of those things and the fact that this precinct will change dramatically from a connectivity, amenity, and just an overall vibrancy point of view, it will become attractive to other occupiers, particularly given the discount. And we do see it as a little bit of a comparison to that of a South Eveleigh and our ATP assets that some of you may be aware of, because again, that was when we invested in that park initially. There was significant discounts to the Sydney Fringe and the CBD, but there was an enormous amount of potential within that area for infrastructure investment as well as development. So it's very much a similar situation in our view, in terms of discount to other markets from a rental point of view, but also future potential for a re-rating of the area. So I think that's all I would like to touch on today. So I'll probably wrap it up there. But if there's any other questions that you have, please don't hesitate to contact myself or anybody from our investor relations or distribution team, and we'd be more than happy to answer them as soon as possible. So, well, thank you very much for your time, and I'll finish it up there. Thank you.